What is going on, everybody? Welcome to the March edition of our live Q&A sessions. I really appreciate the opportunity to be on right now, and I am looking forward to being able to get through some questions today. Feel free to post questions in the thread. Feel free to say hello. Feel free to make sure that you can hear me okay. Give me a little post in the comment section that you can hear me. I'm looking forward to just taking a little time out of tax season today and to go through and talk about a few things. We're right smack in the middle of a crazy tax season. Tax seasons are always really intense. There's always a ton of communication, ton of tax work being done. And so right now we're just kind of filtering through all of that stuff and pretty much just getting as much as we can finished. Matt, thank you for the comment. I'm glad you're here. Thank you for letting me know that our technology is working well and all that sort of stuff. But like I said, I love being able to just take a little bit of time away from tax preparation and just get a chance to maybe answer some of your guys' questions. I know like it seems like I get a lot of calls this time of year where it's like, hey, what do you want me to give you? What kinds of stuff are you looking for? What kind of deductions can I get? So this is like just a really good opportunity for me to, get that out to people in a more personable way and make sure that people are kind of set with what they're sending over to us. I always say the more that you guys know, when it comes to all this kind of stuff, the easier my job is. If I have clients who are really thorough and they've spent the time understanding this stuff and they send over, the majority of the things that we would need to complete the tax return, it really just makes the process so much simpler and easier. So I did get a call today. I got a call today where somebody said, hey, you know what? I'm ready to get my business returns worked on, but what kind of stuff do you need from me as far as deductions go? And I was kind of like, okay, well, I mean, I just want everything that you've spent money on when it comes to business. And one of the things that the situations that they were in was kind of in this spot where it's like, well, I need to kind of go through all my accounts and just kind of pull stuff together. And so I thought it's probably worth mentioning today that like when it comes to tax time and we're in this crazy busy cycle right now, and we like I put deadlines on people. Hey, you got to get me your stuff by this day. I know when people don't have their stuff like tidied up and they're figuring it out right now, there's just no way that like they're gonna really grab everything. And so the focus for me is always going to be create a business bank account, have a business credit card, and every time you're doing stuff for business, make sure that you're using that card. I know I've said that before, but what happens when we do that is if you do no bookkeeping throughout the year, you don't get into tax season where you're like, hey, I got to crawl through all my different stuff and look for what my deductions are. So, he was specifically asking about, can I write off my continuing education? Can I write off my training? Can I write off my licenses? And so the standard when it comes to what you can write off is a pretty I don't know if like vague is the right word, but like what the IRS would say is that anything that's ordinary and necessary in your normal course of business is deductible. And so, like, of course, continuing education is going to be deductible. And I mean, sometimes I probably take those types of questions for granted because I'm just like so ingrained in this. But like, yes, your business license is going to be a deduction. Like meals that you have with business associates or networking type events or social gatherings related to business. Like those types of things are going to be deductible. And so, I want to keep that out there where I say anything that's ordinary and necessary in your normal course of business. And there's so many different types of businesses that you guys are really the ones that are, kind of determining, hey, this is, related to my business. And so, we had a little brief conversation. I said, I want you to write off, all those things that I just mentioned. I need a mileage log from you so that we can get an auto deduction. We need telephone, utilities, office expenses, supplies, computers, internet, equipment, all those different things that we all pay for, insurance and all that kind of stuff, are tax deductions. But, I think where I'm at with things, especially me doing this kind of stuff, is I want you to know this stuff like throughout the year. Like I never want you to be like trying to get your 2022 tax return done and in 2-3 months or 4 months, 6 months into the year, you're like, hey, what am I allowed to deduct? Like that is not going to be effective and efficient. And so this is why I really love doing this kind of stuff, is because I know that the education has to be out there. That's why Prosperity Society is what it is because we want people to educate themselves. Now, there's going to be some people who will never educate themselves. And the reality is they're only screwing themselves, but that's the decision that they are making. And so for us, let's focus on being proactive about this type of thing. If there's anything that you're ever wondering about, where you're like, I ended up going out to dinner with my wife for date night, but we talked about business. Is that deductible? When you have those things that maybe fall into that gray area and you're wondering about it, that's what this type of meeting would be for, is to discuss something like that. Or, feel free to shoot an email over and just be like, this kind of seemed to fall into an area where I was unsure. What do you think? And typically we'll have a little bit of a discussion about it and see if it's ordinary and necessary for your normal course of business. And so on something like that question that I just threw out there, I would be like, well, hey, is your wife involved in your business at all? Or does she just not participate in it at all? No, she does my marketing. Okay, well, that's something that would kind of side with she's involved. Or, is this a one-time meeting where you just got out and you talked about it? Or is this hey, every single Friday night we go on date night and I'm trying to run all of those through my business? That might look a little more fishy. So there might be some scenarios like that where maybe you just get a third opinion on it and kind of go through some of that stuff. So anyhow, that's some stuff on deductions that I kind of wanted to just cover, just a little bit for you guys. The other thing that I thought was worth mentioning, just because there's been some stuff in the news about it, is how we set our entities up. That is a question that I get quite a bit, is do I need an LLC for that? Do I need to set up a company for this? And so I kind of want to speak to that a little bit and just talk through some of the ins and outs. Now, some of you guys know this, some of you guys don't, but for 4 years, I was the director of tax at a company called Anderson Business Advisors. Anderson Business Advisors is a massive law firm, and they do all kinds of different things. Now, in my experience there, I worked with lawyers and, went and taught seminars with them and listened to all their trainings, and definitely got a good insight on entity formation, when we need businesses and that sort of thing. Lawyers love setting up LLCs, and that's their gig. They want to box off everything that they can for you and charge you $1,500 every time for doing it. And we love them for it in some ways. In other ways, it can be overkill. And so, what I always would want to start people out when we're talking about entity formation is going to be something along the lines of having kind of a risk analysis on like who you are. Like, what is your risk analysis? And what's up, Wyatt? Thanks for dropping in. So, I want to know what somebody's risk tolerance is. And if somebody is just like shaking in their boots, always scared, very nervous, and all of that sort of stuff, I may lean towards that person maybe feeling more comfortable with a complex asset protection structure. Now, if somebody is like, hey, you know what? I live in California. I don't want to have $800 LLCs for every single one of my properties. I'll throw 2 or 3 rentals into each LLC and I'll feel comfortable with that. Then maybe we can do something like that. But first and foremost, what I would want everybody to understand is that having an LLC does not like magically unlock like all kinds of like tax deductions. You can still take tax deductions even if you are a sole proprietorship. So just keep that in mind. Like, you can definitely still take deductions if you report income on a Schedule C. Or if you have a rental property in your own name, you can still take deductions on that. Now, that's not me saying don't get an LLC. I still think that there's really good reasons to have an LLC because it is important to get some liability protection. So, if you do have a rental property and you want to kind of protect yourself from lawsuits and that sort of thing, then you can set up an LLC, put your rental property in it. Or, if you have a business, it is a really good idea to kind of just separate that out from you personally and form the LLC. Now, if you're going to be, like selling a few knickknacks on eBay and maybe you're generating $1,000 or $2,000 a year or, even $5,000 to $10,000 a year, but you have a bunch of expenses that goes along with it, then maybe like, going and setting up an LLC might not necessarily be worth it. However, if you have a lot more going on, and I have people who maybe are, running a crumble cookie and they have a piano moving business and maybe they have some Airbnb tiny homes and different things like that, I might actually have that person segment those things out into different LLCs just because it spreads that risk out and boxes off what each of those business purposes is. And it can get complicated. I mean, like, we have some people who will create a holding company in Wyoming because Wyoming will keep it anonymous who owns it, and then they'll have the holding company in Wyoming own all their other businesses so that no one knows who owns those businesses. And so, for a standard kind of run-of-the-mill, straightforward, kind of not even super rich or anything like that, we really could have a situation where we have like 5 or 6 entities set up. Now, I don't always suggest that as well, but again, it's just something that's important to have a conversation about and see what your flavor is, just to kind of understand what you were trying to accomplish. And so, entity setup can be one of those things that is definitely has a need for coaching, has a need for, just a better understanding on. And that's something that, like, I don't profess to be like some kind of expert on or anything like that. But if you have a lot going on, it may be worth kind of checking some of that stuff out. Now, if there's large business, big business, and that sort of thing, you may actually be in a spot where you have to have a very complex situation. If your net worth is north of $20 million, you may have a complex estate plan that goes along with what you're doing. And so, there really is a big run as far as what it is. There's no set way where it's just like, hey, you got to do this. What we deal with a lot would be something along the lines of, hey, I've got a small business. and I'm doing good. It's a service type business maybe, so we set up a lot of S corporations. We want to make sure that people are taking advantage of self-employment tax savings through an S corporation. So we'll have a lot of S corporations, but we also have a lot of people who are in real estate, and they want to know, like, how many LLCs do I actually really need? And so anyways, just kind of want to get some of the juices flowing on some of the entity setup. Kind of that question that I get a lot is like, do I need an LLC for that? And give some of my thoughts on some of that stuff. All right, let's see. I joined one of those stupid Amazon FBA businesses, and it turned out that it was a scam. I spent $50,000 on products, meetings, trainings. Can I file a loss for my LLC on that amount? You can. If you put the money in on that kind of stuff, you may have like a separate Schedule C that you would fill it out on. If it's a partnership and you actually like were an equity partner in it with other people, and that was your share, you probably should get a K1 that would have the loss on it already. But if it was something that you just did kind of on your own, by yourself, that type of thing, there's definitely going to be, the ability to take a loss on something like that. So, good question on that. I wouldn't necessarily like mix that in with any other like businesses that you have. Like, I would show that kind of as a separate business venture where you just lost money. And something that would help too is that if you tried to sell off those products, even if you sold them at like a loss, you would want to try to like recapture as much of that investment as you can, based on the products that you ended up purchasing. All right, let's see. Ray says, if someone were to have their first grandchild, what steps should that person be taking? For example, open a 529 college savings plan, begin gifting $17,000 a year, and that sort of thing. Really good. If that's you and you got your first grandkid, congrats. I would say this is probably one that, there probably could be some varying opinions on, as far as like what you could be doing for the grandchild. I know some people that, don't believe in 529 plans. Like, they just think that they're a total waste. And like, I could see the point on some of that. Like, there's definitely some thought out there that there's much better things that you could be doing with the money, and so but if your goal is to say, hey, I want to be able to pay for my grandkids' college someday, there's no doubt that starting to plug money into a 529 plan is a smart idea. And if you're trying to reduce your personal estate, and you're trying to just whittle that number down as much as you possibly can, doing the gift limitation for the year up to the 529 into the 529 plan, definitely not a bad idea. Now, like, that would be in coordination with that 17,000 a year gifting. So, like, you can't, like, if you're gonna load up their 529 plan, that would be part of the 17K in gifting. So, that could be like an absolute no-brainer where you could say, me and my wife separately, we're gonna take 17,000 each and give it to our grandkid and put it in a 529 plan. And then, what you can do is you could make Ronnie your second grandkid and start putting money into my 520. No, I'm just kidding. But like, but that would be like a really good thing to just like say, if one of your goals is, I just want to make sure that like college is something that is covered, then you can go there. Now, I know some people that might say something along the lines of, okay, the 529 plan is something that's going to have minimal growth year over year. Maybe it'll have a lot of growth. Just depends on what the market does. But over an 18-year period, usually the market goes up. Now, a lot of people might say, what if the kid never does go to college? Then, you have to distribute that money and you have to pay taxes on the growth anyway. So you really didn't get any tax benefits from that. So, something that I see other people say is, well, why don't you, instead of spending $17,000 or $34,000 in the case of a husband and wife, why don't you just buy a rental property with that? And, whatever your cash flow is, from the rental property, you just put into an account for the kid. And so now what you have is you have a rental property that is generating rental income. Somebody's paying down the mortgage for you. Whatever the excess is now going to a bank account for the kid. And an idea there might be something along the lines of, now you have a property that is appreciating. You have somebody paying that mortgage down. You have the cash flow that's going to the kid anyways. And then when the kid gets old enough, they could manage that rental property, in their teenage years, late teenage years, or, whether they do or don't go to college, they may even end up being able to live in that property and, then, not have to worry about housing, or maybe they have a spot where they could live and then have other roommates who help, continue to pay them. So, the idea there is maybe you end up buying a more hard asset than just contributing into this college savings plan and allow that hard asset to kind of work for you. So anyways, that's something that is, also kind of a possibility. As far as maybe trying to accomplish some things for posterity, letting posterity kind of be responsible and learn and be able at some point to roll up their sleeves and just kind of see how business really works, instead of just having grandma and grandpa pay for all of their college. So and there may be another direction on that. I mean, you may have somebody else who might be like, I'm not, my kids are going to be able to figure out their own thing. They're going to work, they're going to have to learn how to work, or they're going to have to learn how to take student loans, pay off student loans and stuff like that. It all just depends what your flavor is and what you're trying to accomplish for your posterity and for your and also to help your kids out too. So anyhow, that's just a few little ideas as far as what steps could be taken, but there's also something called an UGMA, which is a gift to a minor account. That could be something that you could pop $17K in if you didn't believe in the stock market over the next few years. It just kind of depends. So definitely some things to kind of consider and think about there. But those are good. Those are really good questions. Keep them coming, guys. I do have a couple other little questions as far as in the real estate space. All right, so this question is, if you refinance a property and immediately take the cash out from the refinance and invest the funds as a down payment to purchase property number 2, how do you deduct the additional interest paid on the cash out? So additional interest that way is going to be called investment interest expense. The investment interest expense is an itemized deduction that you would take on your Schedule A on your personal tax return. All right, so investment interest expense on Schedule A if you're refinancing properties and using those funds to get additional properties. Now, if you took the money out and didn't invest it in anything, you just used it for personal expenses, that's called a debt finance distribution, and is typically not going to be something that you can deduct. The interest would be non-deductible if you just used it for personal expenses. All right, next question is, if you create a property management C Corp entity to manage all of your real estate properties, you transfer 10% of the rental income from your rentals to the property management company as a property management expense to your rentals. Can you list all the expenses that you can deduct from the property management entity? Okay, so that is a strategy that like sometimes people will use. So what he's saying is, if I have, let's just say I have 5 rental properties. Now, sometimes you can hire a property manager, or you can be your own and self-manage those properties. So what somebody will do is they'll create a separate C Corp, and a C Corp files its own taxes, is not reported on your personal tax return, but it files its own entity, files its own taxes, pays its own taxes. Can you go from your rental properties and say, okay, I'm going to pay 10% of my rents all over to this C corporation, and then have this C corporation function as a property management company? Yes, you can do that. Where I've seen people get into trouble on this is where they try to allocate a lot of their profits from their rentals to the C corporation so that it's not on their personal return. If you're going to have an arrangement like that, you have to pay the property management company a number that is fair. And in the question, they said 10%. That's a pretty standard number when it comes to property management. So property management is pretty typical for it to do that. So you could totally send those 10% over. And let's just say you had, whatever, $100,000 of rental income, and so $10,000 goes to the C corporation. You get to deduct the $10,000 property management expense on this side, but then you have to pick up $10,000 of property management income on the corporate side. But if you have other expenses that are related to the property management company, then you would be able to deduct those expenses as well. I could see that scenario working when you have a lot of rental properties. If you have a significant amount of rental properties, I could see something like that possibly being worth that. All right, so but if you have like 1 or 2, or you just have a couple and you're not really generating significant income for the property management entity, it's probably not worth setting it all up and having to file extra tax returns, having an extra bank account, more bookkeeping to do, and that sort of stuff. But I have had clients before who have 100 rental properties and they self-manage everything. Well, then it becomes interesting because now the property management company is generating, $100,000 a year in income, and then, you can hire yourself, you can create a 401k for yourself, there's different things that you can do to get $100,000 deduction over here, but then write off a lot of that $100,000 through the property management company. So, anyways, if you have a lot of rentals, self-managing through your own C Corp can be a really good idea. All right, if I own a small business, can I pay my wife for hours worked and use it as a deduction? How much can I pay her tax-free? That's not necessarily going to work. That would work more like an in and an out. Okay, so like on one side, yes, your business would get a deduction, but then on the other side, your wife is picking up the income, and that all ends up on your personal return. Now, if you're going to pay your wife, the only way that you're really going to pay your wife is if you want to contribute to Social Security for her and she's like legitimately like working in the business. Because you guys are going to file joint, everything's going to end up. So, that question kind of like just turns into an in and an out. It's kind of like a zero net effect when she's doing stuff. But if you want to pay into Social Security for your wife and you want to make sure that like she's going to get Social Security, like, my wife's a homemaker. And so she never like pays into Social Security. I just pay into Social Security. But if I wanted her to work for the business so that she can get Social Security, then I would pay her a wage and take a deduction at the business level and then, issue her a W-2. But you could pay your kids, and your kids, if your kids are working, if your teenagers are working in the business, you could pay them up to $12,950 without having a income tax consequence for them personally. So, that's kind of a separate strategy, but something that I've definitely done some videos on, on the website. All right, if a couple makes more than $150,000 in W-2 income, is there a way for the couple to somehow deduct any rental real estate losses against their W-2 income? And then maybe this is the suggestion by operating a short-term rental. Okay, so this 150,000. The reason that he's mentioning that in the question is there's a line in the sand when it comes to writing off real estate losses if you make more than 150,000. Real estate losses are generally passive activities. So when you make over 150,000, your passive activities are not a deduction for you. They just get carried over into future years. So if we end up getting into a situation where like, hey, we make 150,000 or more, is there anything we can do? The only way that you could write off passive activity losses is to have passive income. So you would have to have other rental income in order to write off the losses. Otherwise, they carry forward. The only exception to that would be if one of you can qualify as a real estate professional. If you or your wife qualify as a real estate professional, which is 750 hours of real estate work, and it has to be more than 50% of any of your working hours, if you can get through those two thresholds, you become a real estate professional. Okay? Now, when you become that real estate professional, your rental activity is not passive anymore. All right, so that's the only exception if you have straight rentals, and that's single family, apartment complex, whatever it might be. That's the only way to really get around those passive activity rules. Now, one thing that has become really, really popular and more, something that people are doing over the past few years are these short-term rentals, which is like Airbnbs and VRBO properties. The IRS kind of muddied the waters a little bit when it came to short-term rentals. When you have a short-term rental and your average rental day is less than 7 days per year, there becomes this question about whether that should be reported on Schedule E as like regular rental activity, or whether it should be reported on Schedule C as something that's more active. And typically where I lean on this is that the short-term rentals are more active. You are there cleaning them. It's something that you manage more on a day-to-day. You've got hours into it consistently, and you're putting gift baskets out for your people who are staying and that sort of thing. It becomes something that you can now deduct and write off on Schedule C. So if you have a short-term rental, you have a pretty good case for putting it on Schedule C as a business. Now, Schedule C, you could write that off against your W-2 income. So a lot of times what people will do is they'll do a cost segregation on the short-term rental in the first year, get depreciation deductions from them, and they'll end up being in a spot where they can save money on their taxes and write it off against their W-2 income. So a short-term rental is a good way to possibly offset your W-2 income. Now, you need to be working on it. You can't have somebody managing all this for you, because you have to have hours into it. You have to be participating and reach material participation, but it's something that's totally doable, totally possible, and is something that people are taking advantage of right now. So that's some really good questions there when it comes to the real estate stuff. Let's see here. I do these every month. I'm going to kind of wrap up here in a minute, unless anybody has some other questions. But I do these every month. And, some of people jump on now. Other people jump on and listen to it later. And I can appreciate that. And, I'm going to continue to do these. I want to continue to encourage you to come to these. I have some people who send me questions before the event, and that way I'm kind of already loaded up with some stuff here. And so, this is something that for now is free for people to join. And the Prosperity Society is something that we've put a lot of commitment to over the last year, just building out videos, building out answers to really general questions, and putting together some really, really good content that our clients are really enjoying. And so want to encourage people to be smart when it comes to their taxes. This is a lot of Americans' biggest expense. And so when it comes to taxes, we need to make sure that we know what we're talking about. And that's kind of the mission of what we're trying to accomplish. So want to encourage people to just take a look at our site, show it to their friends, and continue to help us build this thing out. And as we do, maybe we'll start doing these types of videos like every couple weeks if we get enough demand for it. But anyhow, want to thank everybody for joining. Appreciate you guys. I am going to get back to tax prep because that's what we do this time of year. Thanks so much.